Our next guest suggests we are in the midst of a premature market rally. Michael Contopoulos is head of multi-asset macro investing at Janus Henderson Investors.
All right.
Michael, welcome.
Thank you.
Congratulations.
Come on. All right.
The deal is official today.
Yes, congratulations.
By Janus Henderson. So congratulations. Nice new title, too.
Thank you.
Why is this rally premature?
Well, I think, listen, there's a ton of uncertainty still out there, most importantly around inflation with oil prices being higher. I think what we saw is in April of last year, you really had a bottoming of core PCE. And, since then, inflation's been trending higher. The economy was quite strong going into this war. You saw ISM prices paid today was through the roof. And oil prices are certainly not helping. And so I think inflation's going to be elevated for some time. Investors aren't giving that enough due. Rates probably need to go higher, and that should suck out some liquidity from the market.
Walk us through why you think inflation will stick, because I feel like that is the out of consensus view, and that most people think that this is a shock and that when the war's over, things will go back to normal and inflation levels will return to what they were prior. So why do you have that view?
Well, I do think that's a possibility, but even if oil went back down into the 60s or 70s, you're still going to be well above 2% on inflation. And you were going into the war. And I think people forget that. We didn't think the Fed was going to cut going into March. We think if things go back to the way they were, they're still not going to cut. The economy is quite strong. Earnings growth is pretty strong. Inflation doesn't seem to be trending towards 2%, certainly not the inflation the Fed cares about. And so there's a chance that oil does go back down. You see headline come down a little bit from the 4% estimates or whatever some of the economists out there are saying today. But it's hard to envision where you get to 2% without a real growth shock.
So if, let's say, Warsh becomes the new chair and there's some resolution with what's happening in the Middle East, do you think it would only be labor that would get the Fed to cut, or would Warsh cut no matter what?
Well, I think there's what should happen and what will happen. I think if Warsh cuts and labor doesn't weaken materially, that's going to be a mistake. And I think the markets are going to punish the Fed pretty meaningfully in that case. And the bond vigilantes are going to come out, and you're going to see much higher rates. You saw that last year, 2 years ago in 2024 when the Fed cut 50, rates went higher. You saw it really since they've cut this go around, rates have gone generally higher. And I think if they were to do it again, given current growth levels and inflation, rates are going higher. So I do think labor is most likely going to be the fulcrum that determines whether or not the Fed cuts. But obviously, if there's if there's some intervention from the administration, then you could have a mistake.
What do much higher rates look like? 4.5, 4 and 3? Is it 5% in the 10-year?
Yeah, I think it depends on really two things. One, if the Fed cuts in the context of 3.5, 4% inflation, I think you can go well north of 5%. If you kind of go back to where we were pre-war, and you're just hovering around 3.2%, something in that neighborhood, 4.5, 4 3/4, I think that's probably where you could settle out. So it's higher from here, I think, on the rate side. It's just a matter of to what degree.